The FM decided to provide debt fund investors with a little bit of relief. The change of taxation on long-term capital gains will not be retrospective. That's what we're hearing from the Finance Ministry. Now, this means if you redeemed your investment before the 10th of July this year, you will come under the old system, which is 20% with indexation and 10% without. Investments made this year, though, will come under the new system, where long-term capital gains will only be applicable if the investment is held for 3 years. Let me bring Dhirendra Kumar in on the phone. Dhirendra, from what you've heard so far, is this relief at all? Because that's just a small portion of investors who might have redeemed their investments before the 10th of July. What about the rest of us?
Yeah, it is the smallest possible relief which the government could have given. This was, investors who invested before the budget, and then the rules were changed. So in that sense, it was the least possible, because the large problem still remains. And I think the fallout of this will be, far too many. One is that everybody who has invested in debt funds so far, including individuals, all the FMPs, they don't have a choice to hold their investment for 3 years, because on a specific date, and most FMP money is less than 3 year old. Most FMPs have less than 3 year term. So everybody will get his money and all their income will be taxable. While when they invested, the understanding was that if they are holding it for over 1 year, it will be treated as long-term capital gains. So that will have a very significant impact, and investors do not have a choice. They cannot pull their money out from FMP. They will get their money on a specific date and it will be taxable. And the money involved is, nearly 1,40,000 crore is invested in FMPs. That apart, all other debt funds, where the investors take up more than one, take a long-term view, including companies, and those, there is a possibility of run on those funds. And I see that this has the potential to cause a disruption in the system, because if a lot of investors now will get an understanding that they will be taxed. They will be taxed in the sense that all the appreciation so far on the debt fund will be taxed at 30%, or their marginal rate of tax, which is the corporate taxation. So they will pull their money out and plan things accordingly. And if a lot of investors take their money out, then the underlying debt market is not liquid enough. So maybe the first 1 lakh crore redemption might not have a problem, but money goes back, and if we see massive exodus in a prolonged way, then it can cause huge disruption in the system.
Two things. One, if you're holding an open-ended debt fund, then you can always keep it for the next 3 years and avoid paying that tax. But if you're in an FMP, then it is going to mature when it's going to mature, and you will have to pay tax. But Dhirendra, what a lot of investors still don't realize, that this is not just debt funds. This is all non-equity funds. So international funds, gold funds, fund of funds, anything that's not 65% Indian equity will come under this regime. Do you expect that to cause panic across the entire industry at this point?
No, I don't expect it to cause panic, but certainly, there is it will dampen the outlook for all those investments, because if you invest in an international fund to diversify your investment, and if you have to necessarily hold it for 3 years, otherwise all the gains will be taxable at the marginal rate, that is too much of a dampener, and I don't think that was the intent of the finance minister. So, and if you look at fund of funds or gold funds, and then there's a problem that, my understanding of before investing in these funds was something else, and now the rules have been changed. So, in fact, one can say that these changes are not retrospective, but from an investor's point of view, it throws a bad surprise.
Well, Dhirendra, when the finance minister announced this change in the budget, he seemed very clear that what he wanted to do was remove the arbitrage opportunity that large corporates have when they invest in debt funds. It's very possible and fairly easy for the government to not have this apply to individual investors, and this was partly one of the things that we had asked for on Investors Guide as well. Do you think that there's any room or any hope at all that individual investors might be exempt at this point?
I don't know, but certainly, government had 3 options. One was to, grandfather all the old investment that has been made. That would have provided some continuity. That has not been done. Differentiated between individuals and companies, and we have a precedence in our tax laws that there have been different tax rate, different dividend distribution tax for companies and individuals. Government has done the minimum, the least possible thing on this, and it has created a great deal of confusion. And I think it is not very much in line with the spirit of the government's intent, as stated in the finance minister's speech itself, where he was saying that he wants to, because if you look at the finance minister's speech in the budget, he said that not too many individuals invest, but which is not true, because it is not about not many individual investors invest, but there are nearly 15 to 20% of money in such funds are by individuals, and all other kind of if you look at the universe of non-equity fund investors.
I want to very quickly ask you what your advice to investors is right now. Obviously, the investments we've made are trapped, but any future investment we're making this year, can we no longer consider debt funds as a short-term alternative? Should we only invest for 3 years? What's your advice for investors right now?
Existing investors don't have a choice. They have to face things as they come by. But if you are in an open-end fund, maybe the 3-year option is still open, but I think this particular move itself can cause great disruption and losses too. But that apart, I think investors do not have a choice for liquid funds. They remain attractive, they remain short-term, and so they remain relevant. But all other fixed income options, I think investors should look beyond mutual fund, because you will have tax-free bonds, other options which one can look at. And maybe, the differential between a deposit and the convenience of a deposit is way too much for one to get into the hassle of choosing a fund and navigating these struggles.